Good day, guys. Today we'll be looking at this question, but we're gonna do it from the perspective of the lessor. So we're basically gonna do it as if from ALTD's perspective, because in the previous video we did it from the lessee's perspective. So basically, with a lease, a lessor can choose how to recognize the lease. The lessor can either recognize the lease as a finance lease, whereby they'll have to de-recognize the asset from their books, or they can recognize the lease as an operating lease, whereby they will not de-recognize the asset in their books. They'll receive income from the lessee to lease the asset, but um, they will continue to depreciate the asset in their books. So let's start with the question. So it says ALTD leases a vehicle from BLTD from 1 January 2017. ALTD did not elect the simplified accounting approach to account for the underlying asset in its individual financial statements, and the following information is made available in connection with the lease. The fair value of the underlying asset amounts to 150. This term is 10 years, equal lease payments of 25,637. A and BLTD incurred initial direct costs of 10,000 and 15,000 respectively. Guaranteed residual value of 20,000, and ownership of the vehicle does not transfer to ALTD at the end of the lease term. Then here at the bottom, it says ALTD accounts for all PPE on the cost model in terms of IS 16, and ALTD always discloses future lease payments in this liability, not separately for the following 4 years. So basically, this is like the accounting policy. So let's start. So we're basically first going to calculate the implicit interest rate. Let's do that. So I'm basically gonna, with this question, I'm gonna do this as I'm gonna show you guys like both perspectives. I'm gonna first do it in terms of a finance lease, and then I'm gonna do it again from the perspective of an operating lease. Okay, so let's get started. First, we'll have to calculate the implicit interest rate because we're given enough information in order to calculate the implicit interest rate for the lease. Then here I'm gonna say excuse the handwriting, guys. Implicit interest rate. Okay, so we're given the N, which was 10 years, the payments, which was 25,637, and then we're given the PV. The present value is the fair value of the underlying asset plus any initial direct costs. So it will be the lessor incurred, which is ALTD, they incurred 10,000. Let me see, ALTD was 10,000. So it's basically gonna be 10 or 15. It's 10,000. So here it's gonna be 160. Then here it's gonna be the future value. It's gonna be 20,000. Then compute the I. It's gonna be 10.03. Wait, here I think it was. Wait, guys, just swap these two around. Let's say they incurred 15 instead of the 10, because it's gonna confuse in that other question. So here, okay, this is what we're gonna get, ne? So let's continue. So this is gonna be our implicit interest rate. So now we're gonna have to do the journal entries for the lease. So now we're gonna have to do the journal entries. So I'm gonna say journals. So here we're gonna say gross investment in the lease. Investment in lease. We're gonna debit this. Then we're gonna credit unearned finance income. Then we're gonna, okay, let me first calculate this so that I can have sufficient space. So this is gonna be the payments, the 25,637 times 10 years. Then we're gonna add the guaranteed residual value. We're gonna add the guaranteed residual value to that. So it's gonna be 10 plus the 20. It's gonna be 276. So here it's gonna be, so since it's a debit, it's gonna be 276,370. Oh, I forgot to also add the initial data costs. So it's gonna be 286. So that's gonna give us 286,370. Then here the unearned finance income is gonna be amount 1 to 10. And that's gonna give us 111,370. Then we're gonna have to, so here in this question, since I'm just showing you guys from different perspectives, they didn't give us the, because this question was only from the lessee side, and I'm trying to show you guys also from the lessor side from like the same question, so you guys don't get confused. So the vehicle here, the fair value was 150. So we'll have to, if we're doing lessor accounting and we're basically the lessor and we're using the, it's on the, what's this, it's a finance lease, we're gonna have to derecognize the value of the vehicle. But since it wasn't given, let's just say the vehicle's value was, the initial cost was 150. Yeah. Then we'll credit the value of the vehicle, then we'll debit accumulated depreciation. Let's say it was 30. It was 30,000. So that would make the carrying amount 120. Hope you guys understand. So basically with this one, I'm just trying to show you, like, if it was a finance lease, we'd have to recognize the vehicle at cost. At cost. And we also have to recognize the accumulated depreciation. Yeah. So this would be this. Then here we'll have to, the last general have to be the profit of the loss. So it's gonna be the 286,370 plus the 30,000, which is the accumulated depreciation, minus 150 minus the 111,370. So the profit here will be 55. So we'll credit the profit on these. It will be 55, 1, 2, 3. So both sides have to balance. You know that you actually did the right thing. Let's continue. So now, since we've already computed the amounts in our calculators, we'll have to calculate the thing. We'll have to account for the lease transactions, the payments, the payment receipts. So we're gonna debit the gross investment in lease, and we'll have to credit bank. So the payments were 25,637, 25,637, and then we'll have to debit unearned. No, this is the other way around. I'm sorry, guys. It's in the middle of so let's do that one again. So we're gonna debit bank since we're receiving money. So if you do what I did in the test, always remember this is we are the lessor, so we're receiving money. Okay. So we're receiving money. So this will be gross investment in this. So we're receiving money, and therefore we'll have to recognize the gross investment. Then we'll have to debit unearned finance income, and then we'll have to credit finance income P&L amort 1 and 1. So this will give us, it's gonna be 16,553, 16,553, 16,553. So this will give us 16,553, and that's how we account for the lease. So these are all the journals that you would have had to do if this was a finance lease. So now let me just write here journals finance. So now I'm also going to show you how it would look like if it was an operating lease. Operating lease. So if it was an operating lease, guys, we basically wouldn't recognize the vehicle. So would basically in our books would just get money, but would never recognize the vehicle in our books because we still have like ownership of it. It's just that the lessee would just have right of use, not right of use of it, but they'll be able to just use it, but it will still be fully in our books. So this is what we would do. We would say 25,637. We'll take all those payments times 10 plus the guaranteed residual value plus the 15,000. What? No, yeah, the 15,000 which we incurred for the whole thing, divide by 10, which would give us 20,000 plus 15. Did I do this correctly? Let me see up there because I think so this plus the 15 would give us 291,370. So guys, here I just made a small mistake here. So this is gonna be 291,370. So that would be it should be 60. Sorry, guys, that 10,000 was just in my head a bit too much. This one, it should have been 15, as I told you guys. It's okay, that's correct now. So here, if it's 15, it's gonna be this divided by 10. So, nope, I'm wrong. So it's basically gonna be 2563 637 times 10 plus 20 plus 15. Oops, my bad, guys. So it's gonna be 291,370 divided by 10. It's gonna be 29,137. So this 29,137, it would be basically what, after we've computed all, it's basically the average of like all our payments over the 10 years, what we would expect to get like over the 10 years. But remember, the lessee will pay a different amount based on what we agreed on. So it's gonna be, we're gonna receive, if this was an operating lease, it's gonna be bank. We're gonna receive every month. Remember, the lessor is gonna be paying 25,637. And we're gonna say operating lease income, which is gonna be the 29,137. Then the difference between the two will be the lease operating lease accruals. I'll just say lease accruals, which is gonna be 3.5, 3,500. So this will be the lease accrual so that this can add up to this. So since it's an operating lease, we also have to account for the depreciation on that vehicle. So it would be depreciation, accumulated depreciation. So since we didn't dispose of the vehicle, I'll just take its fair value. Since there wasn't enough information and this is just an example, I'll take that fair value of 150 and I'll divide it maybe by 10, and the depreciation will be 15,000. Remember this guys, this is just like an illustration, so you can know what to do when you're doing the question. You can at least have the blueprint in your head on how to approach the lease question. So this is how it would look like if it was an operating lease. And this one on top, this is how it would look like if it was a finance lease. So with an operating lease, basically you just account for the payments. There would be no interest and stuff like that. And then you'd also account for the depreciation on your asset, since it's still in your books. The lessor's just using it, but it's still fully in your books. So I hope everyone understands how this was done. And have a lovely day, guys. This will be where I stop the video.